market in the last few weeks is getting pretty comfortable with this idea that we've seen peak yields. The Fed might be getting out of the way. The economy so far hasn't buckled. Earnings back on the upturn, and I don't know, risk back on. How do you see the setup?
You know, I see the setup as very bearish positioning at the end of October. That was amongst professional investors, CTAs. You know, we ended the month of October with fewer than 20% of S&P stocks above their 50-day moving average, and lots of other indicators suggesting that, you know, people were just a bit too bearish. And that usually coils the spring for a rally. We've gotten that fueled by sort of the reemergence of a Goldilocks narrative. And, you know, what happens oftentimes is when stocks rally, that feeds on justifications for that rally, or people create narratives, they craft narratives to fit the rally. And I really think that that's what's happened here. I don't think much has changed. I think the long and variable lags of monetary policy are going to kick in, certainly taken longer than I thought they would, but I don't think the narrative for next year has changed at all in our view.
I mean, there's certainly narratives always do hold sway, and they do change as they follow price and all the rest of it. But that what you say suggests two things. One is that excess of bearish positioning going into the October low may have been an overshoot on its own, and therefore the S&P never belonged near 4,100 this time around. But also, beyond narrative, the 10-year yield going from 5% to below 4.3 seems to take some of the pressure off the market and the economy as well, no?
No, I agree with that. There's definitely a feedback mechanism, a reflexivity between 10-year yields and equity markets. I agree with you. That's part of the relief. That said, where I think the narrative has gone a little bit awry is the reason why yields have come in. Fed funds futures are also now implying about 1.2% cuts for next year. And it's our view that those cuts are coming from expectations for a slowdown, not a soft landing. And so, you know, you've got this circularity here to the reasoning that's beginning to embed itself. But, you know, the Fed history tells us that the Fed has rarely, if ever, orchestrated a soft landing. And I'm just not certain what's changed this time. Yes, yields are leading equities. Clearly, that's helped to support equity risk here. But we just don't think that's sustainable given the trajectory of fundamentals that we're seeing, especially a lot of the high frequency data.
Yeah, I mean, there's no doubt. I mean, even a slowdown is compatible with the idea that ultimately, you know, you get a softish landing, I suppose. It's a matter of whether it really gets worse from there. But, you know, the credit markets seem not to be sniffing any of this out. Does that give you any comfort?
Well, you know, when you look at high yield spreads, I agree with you. They've done nothing but sort of tighten. But there are markets that are sniffing it out. You know, when we look in certain structured credit markets in particular, where we happen to traffic, you know, we think that, you know, a slowdown is being priced in and see pretty good risk-adjusted returns there. And, you know, when we look at relative value from bonds to equities, for example, you know, we just don't see it. When we see an S&P dividend yield of about 1.5% versus, you know, real 10-year yields well above 2, it just doesn't square. And forward equity returns have been very, very low every single time you've had that sort of dislocation.
Yeah, fair enough. The intermarket stuff is not necessarily a pure green light. Peter, good to talk to you. Thanks so much.